Hello, Neil Wilding here with Stonewood Financial, and welcome to Launch Day. It's a big day here in the offices of Stonewood Financial because we are pushing out new software. And great news to all of you. Um, I'm not going to ask you for another penny because of the software, right? It's already included in the membership that you have. So what we're going to cover here, just take a lot of notes. And in fact, if you've already logged in today before this webinar, it's already waiting for you. So let's go ahead and get started. And let's just kind of eliminate some confusion right away. I know what you're thinking. You're like, wait a minute, why is this a annuity on the slide? I came to Stonewood. They're helping me tell the tax message and incorporate that tax and legislative risk message into my day-to-day conversations. Or maybe it's like, hey, you guys just helped me close my first IUL case. What are you doing talking annuities? And actually, our job is not to just help you incorporate the tax and legislative risk message. It's not just a focus on IUL. We're here to help you grow your practice. And so we look for other ways in our industry where maybe we could help. And I know that annuities are hot. These times they've come a long way from back when they were that niche product back in the mid 90s that maybe a few people had learned to incorporate to the part where annuities are a staple to many financial plans already. And so we said, how can we help? And I remember back when I was doing a bunch of annuities, and especially when income benefit riders first became a part of the vernacular and the tool chest that we're using. I remember I used to have a little spreadsheet when I had an income guarantee, and this little spreadsheet helped me kind of tell how powerful that income guarantee was compared to the capital markets. Said maybe a different way, I always wanted to ask the question, what would the capital markets have to deliver to just match what this income guarantee or what this annuity is guaranteeing? I kind of stumbled that one. I'm going to say it again, right? What would the capital markets have to do to just match what the income rider from the annuity is already guaranteeing? And that little spreadsheet that I had helped me sell a bunch of annuities. But it was always just a spreadsheet. And I know a lot of you maybe kind of ask that question a lot or ponder that question. But what we've done here at Stonewood is created software to help you make that calculation. And that calculation is just that. It's like, what would like a managed account have to do? Because that's the competition in a lot of these cases. It's like we're trying to get people to kind of take a more safe approach to their retirement, put an income guarantee in their portfolio. But the question we want answered is like, okay, well, what would that managed account have to do to keep up with this guarantee? And so let's dive into that. Now, the other word that might be a little confusing on your screen there is we're saying the word alpha. And a lot of times we're not really associating annuities and alpha. But allow me to camp out a little bit and kind of talk about this. Because first, let's define alpha. What is alpha? Well, alpha is the performance of an asset class above and beyond an index. And so for a lot of people, it's the S&P 500. And so we're going to say, what kind of alpha can this investment generate above and beyond the S&P or other equities? And so that's the definition of alpha. Why am I talking about it here? Because when we're talking annuities, what are we thinking? Like if I were to say the word annuity and kind of play word association, what are you going to be thinking right now? It's probably something like secure retirement, right? Safe money. A lot of you have even incorporated that concept into your practice and the name of your practice, right? It's secure retirement, safe money. And that's the role that annuities play in a portfolio. I'm not here to change that. What else do you think of? You think of guaranteed lifetime income, right? That's how annuities got so popular. I know a lot of you aren't using the actual riders these days, but they're starting to come around to it, and we're going to give you a reason to here in a minute. But you think like word association, you're thinking guaranteed lifetime income is annuities, right? Or maybe if you're not using a lifetime income rider, you're just thinking of it as a fixed income alternative. Let's eliminate duration risk. let's eliminate interest rate risk, and let's just go and use annuities and kind of plug them into the pie chart as a fixed income alternative. And that's how you all are using them today. So why am I here talking about alpha? And am I really here to suggest that we should consider annuities over equities to then generate a better return? Like, that sounds blasphemous, right? But let's explore a little more, because what I want you to do is rethink the power of guaranteed income. And I want you to rethink the power of guaranteed income to actually generate alpha for our client's portfolio. So now I'm going to kind of define what type of annuities we're talking about here. We're really talking about any type of annuities, mostly in the FIA space, because I know so many of our members are already using FIAs. And there's MIGAs out there. There's just FIAs that are really just accumulation annuities. I'm saying go forward with those for sure. But the software that we've created is actually tailored around these living benefit riders, these income guarantees. And I know that production in those has slipped off a little bit. Most people are doing in the accumulation space, and MIGAs certainly become very attractive. But I want you to reconsider the true power of an income benefit rider, guaranteed income, as a generator of alpha. And so let me explore a little bit more, and let's do it with an example. By the way, this is just one example. The software that we've built works with any type of really financial instrument that kicks off income. And it could be like the FIAs and the living benefit riders that are leveled and they're like guaranteed the same amount for the whole time, or it could be some of these that kind of step up with performance along the way. Heck, it could even be a variable annuity with a living benefit rider. And I know those have kind of fallen out of favor, but whatever type of instrument you're using that guarantees a level, a piece of income, whether it's level or whether it steps up with performance, is going to apply to this example. And so here, what I'm going to look at is a client. You might recognize him. If you've been to Innovate here lately, maybe you already recognize this guy. We like to use him in our examples. And today he's 65, and he has $100,000, and he's going to go buy an annuity with that 100,000. And really, what he wants out of that annuity is an income stream starting at age 70, and that's going to be obviously guaranteed for life. And what we're going to do is we're going to compare that annuity to what we could get in the capital markets. And by capital markets, I'm just going to talk about a brokerage account. But if we're going to do that, we know the brokerage account's not guaranteed. So we have to kind of draw the line in the sand somewhere. So I'm going to show income in this example starting at age 70. We're going to show it lasting till age 95, which would be his assumed age of death in this example. And so what we're going to do is we're going to take that income stream that the annuity is guaranteeing, and we're going to kind of back test that and see what kind of results the brokerage account would have to deliver to match that income stream that the annuity is guaranteeing. So in order to do that, we do have to make some assumptions with the brokerage account. Now, you're not going to see me get up on my soapbox and talk too much about assumptions here. You've seen me do that at Innovate. But here, the assumptions are almost secondary because the software is actually going to go beyond even just these assumptions. But for this case, let's just say that this is a more conservative client. And so they're in a 40-60 allocation. Now, I know a lot of people are thinking, well, wait a minute, shouldn't it be 60-40, 50-50? Software is going to let you plug in whatever you want. But let's just say this one falls on the conservative side. And, 65 years old, we should be in some sort of, pretty balanced portfolio anyway. And so we're going 60-40. I'm going to assume that blended rate from that 40-60 portfolio is 5.3%. And that means that equities are doing 8% and fixed income's doing 3.5%. So those are my assumptions on the brokerage account. I assume a 1% expense ratio here. And then on the annuity side, we're going to guarantee $11,265. Now, the annuity, that's from an illustration that we ran a couple weeks ago with a carrier, in this case, that kind of specializes in how can we maximize the guaranteed income itself from day one. And so this is going to be one of those that's like level through the lifetime. It certainly has accumulation built into it, but the guarantee is the guarantee. I know there are other products out there where the guarantee might start a little lower than 11,000, but will step up and beat it over time. The software works with that one too. But for my case, I just want to look at, okay, what's a pretty popular annuity out there that's kicking off the highest amount of guaranteed income. And in this case, we've got $11,265 a year to this client for the rest of their life for that $100,000 going into the FIA at age 65. So there's my examples. Now, let's look at the analysis first. The software, what it's going to do is going to take that income stream. By the way, carrier neutral, right? There's not even a drop down menu to put in the carrier, because you're just saying, okay, what if I had something that would guarantee me a dollar amount for a period of time? Obviously, that results are going to come from an annuity illustration, or maybe it's an existing annuity or something that they have. But whatever it is, right? And that's why there's no drop down here. We're just going to say, if we had a financial instrument that guaranteed $11,265, and in this case, it's guaranteed for life, but we're just going to show 95 again because we kind of set the range here. That's what we have from that annuity illustration. That's what we got to beat with the capital markets. So we're going to do this through a couple of different views. And this is all like screenshots actually from the report, from the software that we've created. The first thing it's going to do is it's going to say, okay, Mr. Brokerage Account, I see the $11,265 that the annuity is guaranteeing. And the brokerage account, you can take a withdrawal, right? And you can absolutely take $11,265. You can take as much as you want out of a brokerage account or managed account, right? Take as much as you want. But what's going to happen, right? If we take too much too soon, then we're going to put the income stream in jeopardy, and you could run out of money because we took too much. And that would absolutely happen in this case, based on the assumptions that we gave the brokerage account. If that account was stressed with an $11,265 distribution every year starting at age 70, you could take it, but that income stream would last only to age 83. Now, if your life expectancy is in the early 80s, maybe you're fine with just having an income stream to your life expectancy. But to me, that's only half the story, right? I got to make sure I got something to last longer than just that, because I'd like to live longer than my neighbor. All right, so that's just one level of analysis. Okay, so if 11,265 is going to stress this brokerage account to the point where it's going to run out of money at 83, I can make it last to 95. We just got to take less, right? And so the software is going to calculate that for us too. And so yes, that managed account that's kicking off, remember that's a 5.3% growth rate, if you remember from the blended rate, and then fees are backed out of that. The income stream would be $7,648. So yeah, we can make it last to 95 with a brokerage account with the assumptions that we have, but you got to take a pay cut, and nobody wants to do that, right? So very quickly you're seeing, wow, this annuity is doing pretty well. And so now we're really, and this is to me the biggest takeaway from the software, is this next part. And this is where we're going to say, well, what would the capital markets have to do to just match it, right? And so forget our assumptions, right? Forget what we assumed. And we're going to say, what would it actually have to return to just match what the annuity is guaranteeing? And the answer in this example is 8.12%. Now, let that sink in for a minute. First off, remember, that's a blended portfolio. So if we're like 40-60, that means the equities have to do some really heavy lifting to get us to that blended rate of 8.12%. So very quickly you're seeing, wow, the power of this income rider. Obviously, we're using annuities to guarantee income. That's the point. But the delivery mechanism for that guarantee is actually a driver of returns, of alpha. Because look at how hard the equity markets would have to work just to keep up with what's guaranteed here. So if we're in a 40-60 portfolio, and remember, I assumed for my fixed income, I assumed 3.5%. So if I'm getting 3.5%, again, you can plug in whatever you want for your for your assumptions. I know short-term rates are a lot higher than that right now. You can get 5-6% from a savings account almost now. But that's not long term, and we're planning this out long term. And so if we're going to model this realistically, I'm probably only going to get about 3.5%. Historically, it's even been a lot less than that, right? I'm only going to get 3.5% for my fixed income. But if I'm in a 40-60 portfolio, so remember, I got to get 8.12 blended out of this thing just to match what the annuity's doing. And that means only 40% of my account is tied to equities, and the other 60% is earning 3.5%. That means the equities would have to do 15.05% in order to get me that blended rate of 8.12. And all it does is get me back to what the annuity was already guaranteeing. And so you can see here how this can be such a powerful, powerful story. And we kind of beg that question. Maybe you're spreadsheeting it before, and you already kind of knew that annuities were this good of a deal. Now, obviously, what assumptions are making this such a good deal? It's the longevity piece. It's because I guaranteed, or I'm showing an income stream to 70 to age 95. That's why the equity markets have to work so hard. It's because they need to deliver that income, past life expectancy. Now, if I were to run the software and just plug in age 80, guess what? Managed account would be fine. You're good. But right, see, this is a risk, and longevity is a risk. And so we don't want to just be okay if we die early. We got to think beyond that. We got to think lifespan. And lifespan can go a lot longer than life expectancy. And so when you start putting in realistic, reasonable assumptions on what longevity could look like, that's when the annuity really starts to shine. So this is what the report looks like. Again, it's like if you use our other income reports, all we're doing is we put the annuity on one side, and you put what the brokerage account would have to do on the other, and you just kind of look at them, and a lot of time the math just does all of the talking for you. So to me, I see three key areas that this is going to help your practice as soon as you start using this, which hopefully is like as soon as you get off this webinar, you're going to log in and you can see everything that we have. First, as we said up front, show the FIA as a driver of alpha. And really what we're talking about here is not just the FIA, but it's the guaranteed income riders that can be added to many of the popular FIAs. So to me, first and foremost, wow, it's like a backup plan to show how good of a deal the annuity can be based on the assumptions that we have in place. Right? Maybe it's just for the file, right? I mean, to me, like if you're, I know that regulation is coming. We're all fiduciaries now. It doesn't matter what your business model is. We're all fiduciaries. So if we're offering annuities, what a nice piece of paper, even just for the file, to say, you know what we offered here based on the risk of outliving our money, based on the longevity. Boy, look at what the capital markets would have to do to match that. 2, overcome objections. See, like annuities have come a long way. As I mentioned, they're now a staple in many financial plans, but it's not from a lack of hard work and not from, we've dealt with a lot of like overcoming objections in the annuity world. There's been a lot of myth and misunderstanding on them for years and years and years out there, and some of that still exists today. So you could use this report to help show folks, oh, maybe they're not such the bad deal that some of the press makes out to be. So 2, that's the second thing. And then the third thing, and this one is like wow, is can we bring annuities to a new audience? Now, how are you using annuities today? Right? You build your model, and it's a safe money allocation. So maybe you're doing your managed money if you got a 65. If you're maybe you've done some IUL for the life insurance because we're part of the new holistic here, but the annuity piece is just for the the income piece, right? Maybe we're reverse engineering, looking at Social Security and looking at the income gap, and you use the annuity to plug in the income gap. It's all the sales ideas that you've had for 25 years now, right? But what I'm suggesting is, what if your client doesn't even really need an income rider, but they're just looking for a good deal and a good driver of returns? Maybe you got a high net worth client. It's worth 2, 3, 4, 10 million bucks. And you've already, they didn't really need an annuity because their income's taken care of. But if you could show them like, wow, this income rider, if you're planning on living past life expectancy, look at what kind of extra return you get from this guarantee. And look at how hard the capital markets would have to work just to keep up with this annuity guarantees. Like, this is a good deal. This drives returns. This is alpha. And so this allows you to take it. Now, even if the person that's buying the income guarantee, if they're buying it for a deliver of returns, it doesn't mean you have to take the income and spend it on, whatever our, expenses are. If they've already got those covered, just take that money out of the guaranteed income rider, reinvest it, and it's just part of the plan. And it's because it's such a good driver of returns that I think it's going to open up annuities to a whole new audience. And so to me, that's enough to get excited, all three of those things. So that's going to kind of put a wrap on this. I don't know if there have been some questions that have come in. If you want to go ahead and check out now, you can. Let me see if we've had some questions. Otherwise, have an awesome day. Have fun using this Annuity Alpha software, and please be vocal. Let us know what you think about it, what you like about it, what you might change about it, how it's helping you. I'm really excited to see this out with our members using it today. Some questions that were submitted in advance was kind of some clarification on, okay, all FIAs, like, can I use this with anyone? And I said this during the launch here during the webinar, but yeah, there's not even a drop-down menu for the annuity company. You can use it with any type of vehicle that delivers the income stream like what we're talking about here. So if you have a 4 or 5 annuity companies that you're already used to using Power Forward, they are ready to go now. It really just fits. Just remember, we're kind of focusing in on living benefit riders. And one of the questions we got was, well, wait a minute, why are you focusing on income riders? Like, we're doing so much business in MIGAs and using annuities as like the fixed income alternative as accumulation play. And I say, well, great, you don't need our help there. To me, the income rider was really popular, and it kind of fell out of favor a little bit for these other 2 types of annuities because interest rates have gone up. But see, interest rates going up also helps the income guarantees and really shows how powerful these things can be. And so I think that's the real opportunity we have, is to go back to, like, what's old is new again, is back to these income riders and make them part of what we're doing, again, as a generator of alpha. So let me see if we had some other questions come up here. Let's see here. Yeah, they were all similar of what we've already covered. So here's what I'm gonna do. I'm gonna go ahead and wrap this one up. Thanks again for joining us. If you have questions, if you need help finding it, we've built landing pages to help curate all the new content that we have. We got some training videos out there on how to use the software. By the way, you're gonna find it's really easy. And we've got a whole slew of videos and testimonials out there that help you use and kind of figure out how you're going to incorporate this into your practice. So happy hunting with the new software, and look forward to hearing all of your feedback. Take care.